Retirement has a funny way of turning small bills into giant headaches. Because once that paycheck stops showing up every Friday, you suddenly notice every little thing pulling money out of your account. Property taxes, Medicare deductions, taxes coming out of Social Security checks, fees, monthly charges. And some retirees are paying hundreds, sometimes thousands of dollars a year on things they legally may not even owe anymore. And the crazy part is most people never realize it, not because they're careless, not because they're bad with money, but because retirement is full of rules nobody explains properly. So people just keep paying bills the same way they did at 45, even though the rules completely changed after 65. Now, before somebody watching says, well, this probably only helps low-income retirees, no. Some of the biggest savings in this video actually help middle-class retirees and homeowners the most. But at the same time, if most of your income comes from Social Security, there's a very good chance at least one thing on this list is quietly taking more money from you than it should. And here's what makes this frustrating. Nobody contacts you to warn you. Your county's not going to call and say, hey, you qualify for a senior tax freeze now. The government isn't going to send you a sweet little letter saying, good news, we've been taking too much from your Social Security checks. And the companies that are collecting these payments certainly aren't racing to stop you from overpaying them. That would be a very strange business strategy. So what happens? Millions of retirees just keep paying year after year, sometimes for decades. And today we're going to talk about 5 bills many seniors either do not have to pay at all, or maybe paying way too much for without realizing it. And stay with me because one of these is quietly draining money from retirees every single month, and a shocking number of people don't even know the charge exists until they finally look closely at their statements. Also, near the end, I'm going to cover a few bonus retirement tax rules that could save some homeowners and retirees with investment accounts an enormous amount of money. And trust me, one of them scares retirees out of making financial moves that actually could have helped them years earlier. So let's start with one of the biggest retirement money traps of all. The first bill we need to talk about is one that catches retirees completely off guard because most people assume it's just normal. Taxes coming out of Social Security. And look, some retirees absolutely do owe taxes on part of their Social Security income. That part is true. But here's where things get messy. A lot of seniors are having money withheld from their checks every single month without ever stopping to ask whether the amount even makes sense anymore. And for some retirees, the correct amount may actually be zero. That's the part people miss. See, whether your Social Security gets taxed depends on your total income. Not everybody gets taxed the same way. Some retirees are living mostly on Social Security and owe little to nothing federally. Others may owe taxes on only part of their benefits, and higher income retirees can owe more, but millions of people just automatically keep withholding taxes from every check because somebody told them years ago to play it safe. And that sounds responsible until you realize the government may be holding onto your money all year long only to hand it back later as a refund. That's basically giving Uncle Sam an interest-free loan because everybody got nervous during retirement paperwork season. Now, here's where this gets even more important. Starting with the 2025 tax year, seniors age 65 and older qualify for an additional senior deduction under the new tax law. And for many retirees, that extra deduction could lower their taxable income enough to reduce or completely eliminate the federal taxes they owe on Social Security. So, some retirees who used to owe taxes may owe far less now, but nobody automatically updates this for you. The withholding just keeps happening quietly in the background unless you actually look at it. And retirees miss this all the time because the deductions feel small month to month, maybe $40 here, $70 there. $100 somewhere else. But over an entire year, that's real retirement money disappearing, especially when groceries now cost approximately the same as a small kitchen appliance from 2007. Now, to be clear, this is not just for lower income retirees. Middle class retirees can benefit from this too, because the new deduction phases out gradually. A married couple can still earn well into six figures before losing the full benefit. So this is one of those rare situations where both the retiree living mostly on Social Security and the homeowner with retirement savings could both be overpaying at the exact same time, or just in different ways. And fixing it is honestly pretty simple. You look at what you actually owed last year, not what you fear you might owe, not what somebody guessed 5 years ago, what you actually owed. Then you adjust your withholding accordingly, because retirement is expensive enough already. You don't want extra money quietly leaving your Social Security check every month just because nobody ever told you to revisit the numbers. Now, the next bill is the one that makes a lot of retirees genuinely frustrated once they discover it, because unlike some of the others, this one can cost people thousands of dollars over time. Property taxes. And this is where a lot of seniors accidentally talk themselves out of savings before they even check what their state offers. Because many homeowners assume, well, I probably make too much, or my house is paid off, so I doubt I qualify for anything. Meanwhile, they're continuing to pay rising property taxes every single year, like nothing changed after retirement. But here's what many people don't realize. A surprising number of states and counties have special property tax programs specifically for seniors, and some of them are extremely generous. Now, some are income-based. Those are designed mainly for retirees living on smaller fixed incomes. But others have absolutely nothing to do with income. That's the part that shocks people. There are counties and states where simply turning 65 unlocks tax freezes, exemptions, reductions, deferrals, and caps on future increases. And a lot of retirees never apply because they assume somebody would have told them already if they qualified. Nope, that's not usually how this works. The county isn't sitting around saying, quick, everybody, let's make sure seniors pay less property tax this year. In fact, the less people who apply, the more money the county keeps collecting. So millions of retirees just continue paying full price forever because nobody explained the rules clearly. And here's where this gets especially painful. Some retirees bought their homes decades ago for prices that sound completely made up today. Back when a nice house cost less than a modern pickup truck. Now, those same homes may be worth 3, 4, 5 times more than what they originally paid, which means property taxes in some places have climbed aggressively over the years. So retirees end up in this bizarre situation where the house is technically paid off, but the taxes start feeling like a second mortgage nobody warned them about. And this is exactly why these senior programs exist. For example, some states freeze part of your property taxes once you reach a certain age. Others reduce the taxable value of the home itself. Some offer large exemptions for lower income seniors, but almost none of these programs are automatic. You usually have to apply, and that's the trap. A retiree can qualify for years without ever filing the paperwork, meaning they legally could have been paying less all along, but the money just kept leaving their account anyway. Now, again, this is not only for struggling retirees. That's one of the biggest misconceptions. Some programs absolutely target lower income homeowners, but others help middle-class retirees and longtime homeowners the most. Especially people whose homes appreciated massively over the years. So whether somebody is living mainly on Social Security or sitting in a paid-off home worth $500,000, there's a very real chance they should at least be checking what their county offers, because property taxes are one of those bills that quietly rise in the background year after year until suddenly retirees look up and realize, wait, why am I paying this much to stay in a house I already own? Now, the next bill is one retirees almost never notice at first because the money usually disappears automatically before they even see it. Medicare premiums. And there are actually two completely different ways retirees end up overpaying here. One affects almost everybody. The other mostly hits retirees who had decent incomes before leaving work. Let's start with the first one. A surprising number of people are paying for parts of Medicare they may not even need to be paying for in the first place, because retirement paperwork is about as simple and relaxing as assembling furniture with missing instructions, specifically Medicare Part A. For most Americans, Part A freight, the hospital coverage portion, should cost absolutely nothing in monthly premiums if they or their spouse worked long enough and paid Medicare taxes over the years. And most people did. We're talking about decades of payroll taxes coming out of checks. But some retirees still end up paying unnecessary premiums because of confusion involving work history, enrollment timing, or spousal eligibility. So right away, this becomes one of those retirement bills worth double checking instead of assuming the government automatically got everything perfect the first time. Because occasionally its government paperwork has been known to make life interesting. Now, the second Medicare money trap is the one that really catches higher income retirees off guard. And it has one of the least friendly names imaginable, IRMA, which sounds less like a Medicare surcharge and more like somebody's aunt who aggressively brings potato salad to family reunions. IRMA stands for Income Related Monthly Adjustment Amount. Basically, if your income crosses certain levels, Medicare starts charging you extra for Part B and Part D coverage. And here's the part that frustrates retirees the most. The government doesn't use your current income. They use your income from 2 years earlier. So imagine somebody retires this year after earning a strong salary for decades. Their income drops dramatically after retirement. But Medicare is still looking backward at those old higher income years and saying, well, looks like you can afford bigger premiums. So retirees end up paying surcharges based on money they aren't even earning anymore. And because these deductions often come quietly out of Social Security checks, many people never question them. They just assume this is normal now, but sometimes it's not. There's actually a process retirees can use to request a reassessment after major life changes like retirement, loss of income, divorce, death of a spouse, and a shocking number of retirees have never even heard of it. Meanwhile, the overpayments continue month after month automatically. This is why retirement can get financially dangerous in such sneaky ways. It's usually not one giant catastrophic expense. It's 100 smaller leaks nobody notices quickly enough. An extra Medicare surcharge here, unnecessary withholding there, property taxes that never got frozen, fees quietly stacking up in the background, and over time, all of it adds up to real money. Now, the next bill is probably the most emotionally exhausting one on this entire list because people assume there's no way around it. Federal income taxes. And to be clear, yes, many retirees still owe federal taxes in retirement. But what surprises people is how many seniors are paying far more than they actually need to, because they have no idea how dramatically the rules can change after 65, especially now, because beginning with the 2025 tax year, there's an additional senior deduction available for Americans age 65 and older. And for some retirees, this changes the math in a very big way. Now, this is where people immediately split into two groups. One group hears tax deduction and assumes that's probably only useful for wealthy people. The other group assumes, well, I'm definitely too comfortable financially to qualify for anything. And both groups can end up being wrong at the exact same time because this deduction was designed to reach far more retirees than people realize. For lower income seniors, especially those living mainly on Social Security, this additional deduction could reduce federal taxes dramatically, and for some retirees, potentially all the way down to zero. But middle class retirees can benefit too. This is especially true for couples with pensions, retirement withdrawals, or moderate investment income who still fall within the income thresholds. And here's what makes this especially important. Most retirees continue handling taxes almost entirely based on habit, the same habits they had while working, the same withholding patterns, the same assumptions, the same fear of getting in trouble with the IRS. So people keep over withholding, overpaying, overestimating what they owe just to feel safe. And honestly, that fear is understandable. Nobody wakes up hoping for a romantic evening with tax documents. But retirement taxes often work very differently from working years taxes. And that's why some retirees are shocked when they finally sit down and realize, wait, I barely owed anything last year. Or worse, they realize they've been overpaying for years. And one of the biggest reasons this keeps happening is because people assume the system automatically adjusts itself. It usually doesn't. The IRS is not sitting around reviewing retirement birthdays saying, congratulations, Margaret, we noticed you now qualify for additional deductions and lower withholding. You have to actively claim the benefit. That's the game. And retirees who don't revisit their tax situation after leaving work are often the ones quietly leaving the most money on the table, especially because retirement is one of the few times in life where your income structure can completely change in just a couple years. Some retirees go from full salaries to mostly Social Security, to retirement account withdrawals, to required distributions later on. Everything shifts. But many people never update their tax strategy along with it. And that's exactly how federal taxes quietly become one of the biggest retirement money leaks of all. Now, the next bill may not sound as dramatic as property taxes or Medicare premiums at first, but this one quietly drains money from retirees every single year simply because people assume, well, taxes are complicated. I probably need to pay somebody. Tax preparation fees. And look, there are absolutely situations where hiring a professional is the smart move. If somebody sold a business, has complicated investments, multiple rental properties, state issues, large capital gains, then yes, paying a good tax professional can save you far more than the fee costs. But that's not who we're talking about here. We're talking about retirees with fairly straightforward returns. Social Security, maybe a pension, maybe a retirement account withdrawal or two. A couple investment statements, nothing wildly complicated. And yet every year, millions of seniors walk into chain tax offices and pay hundreds of dollars to have somebody type numbers into software for an hour, sometimes more. And what makes this even crazier is that many retirees legally qualify for free tax preparation programs specifically designed for older Americans. Not discounts, actually free. One of the biggest is called Tax Counseling for the Elderly, or TCE, which was created specifically to help seniors with retirement-related tax situations. There's also ARP Tax Aid, which operates thousands of locations across the country. And no, retirees do not have to be AARP members to use it. That surprises a lot of people. Now, again, this isn't just for retirees struggling financially. That's another misconception. Many of these programs are aimed at older adults with modest to moderate incomes, which includes a huge portion of middle-class retirees. So the same person paying $300 at a storefront tax office every spring may have qualified for free help the entire time and never realized it. And honestly, part of the problem is fear. Taxes make people nervous. Retirement taxes especially, because retirees worry, what if I do something wrong? What if I miss a form? What if the IRS shows up and ruins Thanksgiving forever? So people default to paying whoever's sitting behind the desk with a calculator and a reassuring smile. And again, sometimes that absolutely makes sense, but not always, especially now that many retirement returns are simpler than people think. In fact, some retirees are paying significant preparation fees for returns that mostly involve information already reported directly to the IRS anyway. The forms are already there. The income is already documented. The software already knows where most of the numbers go. And yet, retirees continue paying more every year because nobody told them another option existed, which honestly fits the pattern we've been talking about this entire video. That's how retirement overpayments usually happen. No, not through giant financial disasters. Through smaller recurring costs, people stop questioning. A withholding here, a premium there, an unnecessary fee every spring. Money quietly disappearing through routines people never revisited after retirement began. And the really frustrating part, some retirees work their entire lives trying to build financial stability only to spend retirement accidentally overpaying for things they legally could have reduced years earlier. Now, before we wrap this up, I want to cover a few bonus retirement rules because these are the kinds of things that can save certain retirees an enormous amount of money, yet hardly anybody talks about them outside of financial circles. And the first one involves something that scares a lot of older homeowners almost into financial paralysis: selling the family home. Because there are retirees sitting in houses that became way too large, way too expensive, or way too difficult to maintain years ago, but they're terrified to sell because they think the government is about to take a massive bite out of the profits. Especially people who bought decades ago, back when homes cost what now sounds like the price of a microwave and 2 lawn chairs. So retirees see their house jump from maybe $70,000 decades ago to $500,000 today when they immediately panic. We'll get destroyed in taxes if we sell. But in many cases, that giant tax bill retirees fear never actually shows up because there's a home sale exclusion that allows many homeowners to exclude a very large portion of their profits from federal taxes when selling their primary residence. And for married couples, the exclusion can be massive, meaning some retirees could sell, downsize, relocate, or simplify their lives without owing anywhere near what they feared. But many never even explore the option because the tax fear alone stops them. And honestly, retirement is full of these invisible mental traps. People become so afraid of possible taxes that they accidentally make financial decisions that hurt them far more. Now, the next bonus move is one most retirees have never heard of, even though it can be incredibly powerful during certain retirement years. The 0% capital gains bracket. And this one surprises people because most Americans grow up assuming investment profits are always taxed. Not necessarily. There are situations where retirees with lower taxable income can sell long-term investments and legally owe 0 federal capital gains tax. 0. And retirees are often in the perfect position for this because income frequently drops after leaving work, especially during that period before required retirement withdrawals begin later on. So some retirees strategically sell appreciated investments during those lower income years while staying inside the 0% bracket, meaning they gradually reduce future tax problems without creating giant tax bills today. Now, obviously, this depends heavily on somebody's total financial picture, but the important thing is simply knowing the rule exists, because most people never even realize this window is available to them. And finally, there's one more retirement strategy that becomes incredibly powerful for retirees who donate to charity, give regularly to church, and have money in traditional retirement accounts. It's called a qualified charitable distribution. And what makes this strategy so valuable is that it allows certain retirees over age 70 and a half to send money directly from an IRA to charity without that money being counted as taxable income, which can help in multiple ways at once. Not only can it satisfy required withdrawals later in retirement, it can also potentially lower the income calculations tied to other retirement costs and taxes. And this is exactly why understanding retirement rules matters so much, because one financial move in retirement often affects 5 other things connected to it. Income affects Medicare. Medicare affects premiums. Premiums affect monthly cash flow. Withdrawals affect taxes. Taxes affect Social Security taxation. Everything connects. And retirees who understand even a few of these rules often end up keeping significantly more of their money over time than people who simply leave everything on autopilot forever. Because that's really what this entire video comes down to. Autopilot. Millions of retirees are still paying bills, fees, taxes, and surcharges based on assumptions they made years ago, without ever revisiting whether the rules changed after retirement. And sometimes the difference between struggling financially and breathing a little easier every month is simply knowing which bills deserve a second look. And honestly, the biggest takeaway from all of this is pretty simple. Retirement changes the rules financially in ways most people never get warned about. So if you've been paying the same bills the same way for years, this is probably a good time to double check everything, because some of those normal retirement costs may not actually be as normal as you thought. And if you found this video helpful, make sure to hit the like button so YouTube will stop recommending you videos about 25-year-olds waking up at 4 a.m. to invest in alpaca farms. Also, subscribe if you enjoy this kind of retirement content. And if you know somebody over 65 who's still paying way too much for something right now, send this video to them. There's a very good chance one small piece of information in here could save them real money. Thanks for watching, and I'll see you in the next one. God bless you all.